Wall Street wants you to think investing is complicated. Stock picking, market timing, financial advisors charging 1% fees, actively managed funds with fancy names run by Ivy League graduates. Here's what they won't tell you. Just 33% of actively managed funds beat their index fund counterparts over the past year. That means if you hired a professional stock picker, you had a 2/3 chance of losing to someone who did absolutely nothing except buy the entire market and go to sleep. If you're investing for retirement, this isn't about beating your friend. It's about whether you'll still be working at 70. And it gets worse. Over 10 years, only 21% of active strategies survived and beat their index counterparts. Not 21% underperformed. 21% survived and beat the market. The rest either closed down or fell so far behind they weren't worth measuring anymore. There's a simple investment strategy that beats 90% of Wall Street professionals. It costs almost nothing. It takes 20 minutes to set up. And you can start with $100 a month. The reason nobody does it? It's boring. And boring doesn't make anyone rich except you. This is Easy Street Invest. I break down money strategies that actually work for real people, not just trust fund kids or Wall Street insiders. In the last 2 videos, we built margin by redesigning your costs, and we talked about strategic career moves to increase your income. This video answers the question most people get wrong next. Where does that extra money go? If you've been building margin like we talked about in video 2, and increasing your income like we covered in video 3, you now have cash flow. Most people waste this opportunity. They either leave cash sitting in a savings account earning nothing, or they panic and throw money at whatever stock is trending on social media. Here's what smart people do instead. And it's so simple, it sounds like I'm lying. The investment nobody wants to talk about. Index funds. That's it. That's the strategy. I know what you're thinking. That's not a strategy. That's just buying everything. Exactly. And that's why it works. An index fund is a basket that holds every stock in a specific market. The S&P 500 index fund, for example, owns all 500 of the largest U.S. companies: Apple, Microsoft, Nvidia, McDonald's, Home Depot, everything. When you buy an index fund, you're not betting that Tesla will beat Ford. You're betting that American capitalism will continue to function. And over the long term, it has. The S&P 500 has returned about 10% annually for the past century, including crashes, recessions, world wars, and pandemics. But here's the uncomfortable truth. The financial industry hates index funds. Because if everyone figured out that buying the whole market and doing nothing beats 90% of professional investors, entire business models collapse. Financial advisors charging 1% fees, actively managed mutual funds, stock-picking newsletters, trading platforms encouraging you to day trade. All of it depends on you believing that investing is complicated and you need an expert. You don't. Why simple beats smart? Let me show you what actually happens when professionals try to beat the market. In 2025, just 38% of active strategies survived and beat their average passive counterparts. And this was during a volatile year with tariffs, elections, and geopolitical chaos, exactly the kind of environment where active managers claim they add value. They didn't. They failed again. This data comes from long-term studies tracked by S&P Dow Jones Indices. Over 15 years, market indexes outperformed over 80% of active funds in every single category, from small cap to large cap to real estate. In some categories, over 90% of actively managed funds were beaten by their benchmarks. If this were any other profession, 80% failure would end careers. In finance, it gets you a bigger office. So why do smart people with MBAs and decades of experience keep losing to a simple index fund that just sits there doing nothing? 3 reasons. First, fees. Active funds typically charge around 1% annually, while index funds charge 0.05% or less. That sounds like a small difference, but over 30 years, that 1% fee costs you hundreds of thousands of dollars in lost compound growth. Second, taxes. Active funds trade constantly, buying and selling stocks, trying to time the market. Every trade creates a taxable event. Index funds barely trade at all because they just hold everything, which means you keep more of your returns. Third, ego. Professional fund managers can't just sit there and do nothing. They're paid to be active, to make decisions, to justify their fees. So they trade, they chase trends, they panic during crashes, and get greedy during booms. And all of that destroys returns. Meanwhile, the index fund just sits there, quietly outperforming. The math that matters. Let's say you start investing $100 a month in an S&P 500 index fund at age 25. You do this for 40 years until you're 65, earning the historical average return of 10% annually. At 65, you'd have about $632,000, and you contributed only $48,000 of your own money. The other $584,000? That's compound interest doing the work while you lived your life. Now let's say your friend does the exact same thing, but they use an actively managed fund charging a 1% fee. After 40 years, they'd have about $467,000. That's $165,000 less. Not because they made bad investment decisions, not because they picked the wrong stocks, just because they paid someone 1% a year to underperform the market. That's the hidden cost of complexity. Why this feels wrong. Here's the problem with index investing. It doesn't feel smart. You're not analyzing earnings reports. You're not predicting market crashes. You're not timing entries and exits. You're just buying everything and waiting. And that makes people uncomfortable because our brains are wired to believe that complex problems require complex solutions. So when someone tells you the best investment strategy is to do almost nothing, it feels like a trick. Let me tell you about someone I'll call Marcus. He's 29, works in tech, makes $85,000. He's been researching investing for 3 years, reading blogs, watching YouTube videos about options trading, following stock picks on Reddit. He's analyzed hundreds of stocks. He's built spreadsheets. He knows the difference between a REIT and an ETF and a SPAC. But he hasn't invested a single dollar because he's waiting to feel smart enough, confident enough, ready enough. Meanwhile, his coworker who knows nothing about investing set up automatic $200 monthly transfers into a target date index fund 3 years ago. She's up $8,000. Marcus is still researching. The irony? She made more money by knowing less. What to actually do? If you want to start investing with index funds, here's the simplest path. And here's the thing nobody tells you. Every year you wait costs you more than the last. Not because the market is going up, but because you lose compound time you can never get back. Step 1. Open a Roth IRA at Fidelity, Vanguard, or Schwab. Takes 15 minutes. You'll need your social security number and bank account info. Step 2. Set up automatic monthly contributions. Start with $100 or whatever amount you built into your margin from video 2. The key is consistency, not size. Step 3. Buy a total stock market index fund or an S&P 500 index fund. At Vanguard, it's called VTSAX or VTI. At Fidelity, it's FZROX or FSKAX. At Schwab, it's SWTSX. They're all essentially the same thing. You own a piece of the entire U.S. stock market. Step 4. Do nothing. For decades. Ignore market crashes. Ignore hot stock tips. Ignore anyone telling you to time the market. Just keep contributing every month and let compound interest do its thing. That's it. That's the whole strategy. And if you do one thing this week, open that Roth IRA account. Don't wait until you know more or have more money. The best time to start was 10 years ago. The second best time is right now. The trap most people fall into. Here's where people mess this up. They start investing in index funds. They're consistent for 6 months, maybe a year. And then the market drops 15%. Suddenly, their $6,000 account is worth $5,100. They panic. They think, maybe I should sell before it gets worse. Maybe I should wait until things stabilize. So they sell. And then the market rebounds, and they miss the recovery, and they just locked in a permanent loss by trying to be smart. This is why even during volatile periods with elections, tariffs, and geopolitics, active managers still underperformed indexes, because they couldn't resist the urge to do something. The hardest part of investing isn't picking stocks. It's doing nothing when your brain is screaming at you to act. Why the system needs you to fail. Let me say something uncomfortable. The entire financial services industry is built on the assumption that you will not do the simple thing. If everyone just bought index funds and held them for 30 years, financial advisors would lose billions in fees. Actively managed funds would shut down. Trading platforms would collapse. Stock-picking newsletters would go out of business. They need you to believe investing is complicated. They need you to feel anxious about the market. They need you to trade, to chase performance, to second-guess yourself, because every time you make a move, someone makes money. And it's not you. Index investing is an act of refusal. You're refusing to play a game where the house always wins. You're refusing to pay fees for underperformance. You're refusing to believe that complexity equals results. And the moment you do that, you become a threat to an industry that profits from your confusion. The $100 a month investment that beats Wall Street isn't complicated. It's not exciting. It won't make you feel smart at dinner parties, but it works. And in 30 years, when your index fund has quietly compounded into a 7-figure retirement account, you won't care that it was boring. Because boring made you wealthy, and trying to be interesting kept everyone else broke. The question isn't whether this strategy works. The data is overwhelming. Over 80% of active funds underperform over 15 years. The question is whether you're willing to be boring enough to let it work for you. Most people aren't. That's why Wall Street stays rich. But you don't have to be most people